Okay, welcome everyone. We'll start lesson 2. Today lesson we'll go through LO2, which is learning outcome 2. As you know me, my name is Anjum Satar. If you have any question, please drop me email. This lesson LO2 is about critically we looking and measure the performance of the businesses, how we can and so today lesson will be focused on financial statement estimate exemption related to profit and loss and balance sheet and cash flow. Ratio analysis, interpretation of ratios, that will be key in our lesson, and we'll go through key ratios. Is the liquidity, which means converting asset into cash or near cash, and efficiency ratios, how efficient we use our resources to maximize our profit, and profitability itself is a performance which we look, and that will be key in our discussion today. As on scale 1 to 10, always good to be reflect what you know already about knowledge about costing system, which we discussed in the previous lesson, ABC costing, activity-based costing, absorption costing, service costing, process costing, costing behaviors. We discuss about fixed variable, semi-variable, uh, and those sort of direct, indirect costs. And today key focus will be on the financial ratio. So you can reflect where we up to your because if you learn already in the past, you may be 7, 8. We're looking further how we can apply. So according to International Accounting Standard Board, financial statement key purpose to provide the financial information, and the financial statement should prepare according to the rules and regulation, and it help the stakeholder to make the right decision. That the key purpose, the financial statement of comprehensive income, which is mean profit and loss, statement of financial position, balance sheet, which show the asset, liabilities, and capital, statement of cash flows, which shows operating activities, cash flows, financial activities, and financing activities, how much cash in and out from the business, that will be key. And the statement of change in equity, how many shares we issue, what dividend we paid, all will be. If you want to see, in the statement, we can see on the statements. That's the key. We discussed in the previous lesson as well, ISB, International Accounting Standard Board, conceptual framework, set the principle and the concept. Objective of the financial statement is to provide the financial information, and we can entity use their resources effectively. Going concern mean the business will carry on as a normal for 12 months at least. The financial statement provide and editors give his or her views about the financial statement prepared according to the prescribed rules and regulation. That's the key. The scale of operation. Materiality mean anything which is significant you can keep off the balance sheet, on the balance sheet. Like we have one of the company, Enron is the biggest company, US, and they showed in billions profit and sales, and the asset looked good, but after few months they were not in a position to pay off the salaries to their workers, and the company liquidate. So that's the biggest scandal of history is Enron. So we have a World Telecom and various other scandals in the corporations. So that's the reason going concern need to be truly reflected. Accrual basis, also known as a matching concept. Income and expenses of the year should be recorded under the year. That's we need to be make sure, like if you have an insurance you bought, and in between you sell your car insurance, as long how many months pass, that become your expense. Remaining months is your prepaid. Prepaid is asset, so income and expense recording in the financial statement. On income incurred and the cost, that's all, not the cash received. Cash can be received after 1 year, 2 years, 10 years, depends your agreement, but we do based on the sale and the expense are accounting. In some part of the world, it's still happening. The cash accounting only you record when you receive and paid the cash. So, but we doing accrual accounting. Items are reported in the financial statement. It should be reflect the specific period. Those are related to that period. We mentioned in the previous, qualitative characteristic, we need to be relevant. All information, financial statement should be comparable. Is the timeline verifiability? We can verify what we're saying in the financial. understandable the financial statement need to be relevant materiality, not any transaction we show off, but there are number of creative accountant that can change and manipulate things. Faithful representation information need to be neutral, free from error, complete information. That's as accountant job. Presentation of financial statement. Nowadays, we are following international accounting standard because it's a multinational company. They have operations throughout the world. We becoming a global village. That's why we use the word think globally, act locally. You have to act locally according to the local stakeholders' wishes and desire, and you have to follow the local legislation. Like McDonald's, they have a menus according to the local tradition and the culture. So that's why think globally, act locally, and to standardize this, we have an international accounting standard so people can understand what is ever in the same layout we follow. So when we're looking the financial statement of profit and loss is the always income, expenses, cost of sale, and if you minus all, you will get the profit. So if sales revenue, sale turnover, all the sale itself is all three terms: revenue, turnover, and sales will carry on using cost of sale, how much you bought it or manufactured. If you take all the direct costs and you get the gross profit, then you look around other income. If you have investment in other company, you maybe receive the discount or interest, that can be income. And expenses, if you have any overheads, we minus, will get the profit. Okay, then balance sheet, it shows assets, liabilities, and capital. And in the balance sheet, we look around the non-current asset, which is long term. We can use it like property, plant, equipment. Asset mean anything you own it, which flow the future economic benefit. Resource controlled by entity, which will flow the future economics benefit is your asset. If you have a broken chair or you have an old-fashioned clothes, that's not anymore asset because we can't generate the revenue from it. It's not come under the definition. Tangible, you can see it. Intangible, you can't see it. Like goodwill is your asset. Patents, copyrights, your asset. Every individual can need to be thinking about unique selling point is your asset as well. So current asset, the asset which we can convert into the quickly cash, or we call liquid asset, or if we want to be liquidity ratios, we look current asset divided by current liabilities. Non-current liability long term, which is required more than a year to settle. Current liability mean the legal obligation by law you have to, which arise from the past. Even if you've done something in the past, that's why you have a liability. Trade payables, bank overdrafts, and these is need to be settled within a year. Those we call current or the short term. If we will minus asset minus liability equal to net asset figure is always equal to the capital figure, or we call equity in case of companies. Okay, so all being explained, financial statement, what shows, as just mentioned, non-current asset, long-term using number of years, current asset, it's carry on its value within a years, non-current liability, long-term mortgage, leases, hire purchase agreement, current liabilities, short-term, which we have to settle within a year, within next 12 months. So we need to arrange the cash for it. And then we look at non-current liabilities, current liability, and accounting equation. I included the link for you here. We can look around next and Marks and Spencer financial statement. So these two statements, and it's a real time. We can look around what is the happening in the current liabilities. We can look around non-current liabilities. We can compare. Always good to be. We see in the characteristic of financial statement comparability. One of that's we need to be look around this. Huh? Any question, Asif? If you have, please feel free ask them. Okay, please, if you have any question.
I'm good.
Okay, great. So financial statement on their own as the limited use. For example, if you identify the business made profit 1 million, what does this tell you about the business? Does this suggest you the business is success? It might, but not in the previous year. They made the profit of 50 million. Their closest revival and 60 million. So we need to be look around. We can compare with the industry averages, and then we can draw who perform better, who have more market shares and best performance and efficiency. Ratio analysis widely used to support the process and comparison don't forget, we can look around other things as well. Really, the financial raw data is equally useful when they're performing analysis. We can look around. Ratios are simply tool, try and assist, understand the comparison. Okay, so that's which we look around when we interpreting the financial statement. It's important to be user accounts and the information they need. Shareholders, stakeholders, different stakeholders mean anybody who has any interest in the business or their interest influence due to the decision of the company is a stakeholder. That's we need to be look around. Primary concern with the receiving or an adequate return on their investment, and also stability, liquidity of the business, suppliers, lenders, management, and potential user, financial institution, implied and professional. So those we need to be look around. A ratio is simply calculation based on the action in the set of the data, which we can one figure divided by other times by. So we can look comparison between two things: asset against liabilities, profitability against asset, and receivable against payables. How quickly inventory turnover, how quickly inventory stock we converting into finished good and using them. Okay, so really we categorize ratios into four major categories. That's good to be. Liquidity. Liquid mean anything you can convert into cash. There are two ratios we use normally under the liquidity: current asset divided by current liabilities. Normally, lot of in a list says £2 worth of asset, £1, 2 to 1. That ratio is very useful. And the quick ratios, which is most liquid, because sometime inventory stock is become outdated, it's difficult, one is willing to buy. Current asset minus inventory divided by current liability, it should be 1 to 1, but it varies industry to industry. That's the benchmark. Okay, then we can look around a financial position ratio. There are only two ratios normally we calculate: interest cover ratio, how much profit or how many time profit is higher than the finance cost. Finance cost mean interest which we are paying on the loan. Gearing ratio, gearing mean it's a high gear, high risk. If you drive your car, high gear, high risk. So non-current liability divided by total equity plus non-current liability. Non-current liability, when we borrow money for the longer period of time, more than a year, we borrow money, like you buying a house, you buying a car, is your asset. That's why it's a link with. That's why we add them into part of the equity as well. Profitability and the use of resources, these other ratios which we also look, all the formulas we've been given. So we can look around return on capital employed, profit from operation divided by total equity plus non-current liability, return on total asset, profit from operation, return on equity, profit after tax. Because when you're paying dividend to the investor, we paying after the tax, the profit, gross profit margin, net profit margin, expenses. Inventory turnover, we can look around how many days inventory been, or how many times inventory convert into the finished good. We compare 2 years. Trade receivable and payable. Okay, trade receivable, always good to be receive money in 30 days or less than, quicker compared to the payable 60 days, 30 days. We have a safety net and we have a cash, the cash position, inventory days, and revenues, and other, that these, the ratios, how efficient we are using the resources. Okay, so each ratio is being explained, the benchmark, and we compare. And we need to be look around other, because maybe before COVID ratios were really good, but during COVID-19 and all, the performance, we need to look around the past: political, economic, social, and technological. There is other model called BSC, is balanced scorecard model, which is given by Kaplan Norton. Is quite good to look around. BSC, balanced scorecard model, that's also help to be understand more and compare the ratios. Ratios always compare with the same size of the company in the industry, year to year, industry averages, and interpret and use for your effective decision making as a manager. So we all the ratios been explained: return on capital employed, profit from operation divided by equity. As in the previous slide, we were given all the formulas, and we can interpret it what this showing. This showing the relationship between two things. So we can calculate these. Yes, return on equity, measure the return ordinary shareholder to their investors. profit percentage and expenses ratios help to measure overall the profitability of the business. Expense, we can look around specific expense again the sale, because overhead expense as a manager try to reduce them efficient. Asset, we want to be used full capacity to measure our return. Liquidity, we want to be most liquid assets, yes, we convert into the cash. That the short-term commitments against the short-term assets, yeah. So assets should be more. Inventory turnover, it shows the rapidly business inventories are sold on the average during the period. Average, we holding period of inventory, average, we collect, and average, we paying to the supplier. So financial, as we discuss about gearing ratios, high gear, high risk. If your ratios come high, it means high risk the company. Okay, that's which we'll look around. So let's we have two companies. There is available on Moodle as well. I'll share with you the question bank in a minute. So which we'll use. So please, if you have any question until now, you can ask. So we've been given two companies. One is called Anika, one is a Paprika. Just ignore the years, is quite old, but it's just give you the concept. So we have a revenue, and so if we look the gross profit ratios, we can say gross profit, which is 16,200 divided by 36,000 times by 100. So just ignore 30 the top. So we can look around previous year, and then we can calculate. We can look around the operating profit. We can look around the finance cost. Yes, all you've been given, and we'll calculate by using the ratios formula. Then you've been given the balance sheet. So we can look around current asset, which is 7123 divided by current liability, which we have current liabilities we've been given here 3876, and we can divide, we can calculate, is it 2 to 1, less than 1, and so on. And that's all, in one of other arts within the slide we calculated. So we'll go through, and the figures came from this handout. So gross profit 16,200 divided by 36,000 is a 45% this year. This company, another is Paprika, is 52.5. According to the gross profit percentage, is Paprika is better than Anika. Anika's margin is 45, and other is a 52. So it's a 7%, 7.5% is a higher. When we look the operating profit, is Paprika is higher than Anika, which is 9%. So you've been given all the formulas across. Gearing ratios, when we look high gear, high return, there are two ratios in a list view, debt divided by debt plus equity, or equity and the debt percentage. So that's 13.2. Other is a 71%. So that's the huge high gear, high risk. So Paprika is a high risk. In business, we call beta. Beta is the risk factor. Higher the beta, higher the risk, higher the return. So if it's a high risk, high return. So return is coming. So is 13.26 is the, but you will see there is the 45, there is the only 7% return difference. But when we look, the risk difference is a huge. So that's help, so we can interpret that this is the highest risk, but the only 7% return. So that's not beneficial. For 7% high return, around your 55+% your risk factor is a higher, so percentage is a less return. So that's why we not prefer the Paprika to invest. So we prefer to Anika, which we look other ratios as well. Yes, you will see 245% and 15%. That's a huge difference. And then interest cover ratios is 11.6 times. They have a profit against the finance cost, because they have a less liability. They have to pay less interest, which is finance cost. And this is only 3.1 times profit is a higher. So that's the is less, it's more risky, because your profit is only, if the 3%, 3 times profit drop next year, you won't be able to pay to the lenders to whom you borrow the money. So we can look around the asset test ratios, like liquidity ratio, current asset minus inventory divided by current liability is 1.2. Every 1 pound of liability is £1 and 22 pence of asset, but the other Paprika is only 65 pence of asset against £1 worth of the liability. So Paprika is more risky than Anika. So that's why we prefer to be. So then we draw the decision which one is the better. Comparison performance is compared with the previous period, and we can look around according to the ACCA article to try to be overcome the problem of vertical analysis, compare the company performance for particular period and equivalent company and the same period, induce independent yardstick, which we can looking around comparison and the type of analysis of the ratios, and we look, other pros and cons, and then we can make the, and we can look around the various stakeholders interested in different ratios. So then we looking the ratios, maybe the particular week in the company had the business plan. We can look around what the future plan. We can look around CSR reports, and always, if we're looking the receivable days and payable days and with inventory turnover days, it's called working capital cycle. How quickly, we can converting things and collecting money, and it's a good cash, so cash is really the lifeblood for any business. It's impact, various decisions which we can make based on user and need to be information in the financial investor, potential investor, lenders, suppliers, customer, and help, determine to buy. Okay, just 1 minute, please. Can we look, this need for information and financial statements? Okay, so we can look around investor, they help, determine whether to invest or hold, yes, that's, potential investors, lenders, whether they loan and interest is paid when dues, they're looking these ratios and they can make the decision. Customer information about the continuous entity, if you're giving them guarantee and warranty, that will be paid off or not. That's, which we need to look around. Government agencies really want to be taxes collected or not. Public also interested what the company is doing for the local people or the welfare. Okay, so based on our previous analysis for these two companies, Anika's gross profit is the better, operating profit is the better, gearing ratios is less risky, and interest cover ratio is better, less, yes, asset test ratio. As far, the profitability is concerned, yes, better ratios are found in Paprika's, and Ika's is profitability ratios, yes, and which is Paprika's is perfectly acceptable, but another also. Overall, we can conclude on, so is more risky is Paprika and less risky is Anika. Anika is better to be invest because, is acceptable level of return and is less risky as well. Okay, that's, which we can look around, and then you've been given some links, please, for further reading, which we can copy and we can access all the required information. And today we discuss about the ratios, and key ratios, those are profitability, liquidity, use of resources, and gearing ratios. That's, and the basis of this, we can make a decision by calculating these ratios, and we can look around the companies of your own choice, and we can find these ratios. We can look around the Yahoo Finance. We can download different companies. Unilever, which is used to be called Lever Brother, Uni and Lever merged together, and now is the Unilever, and that's, when Holland company, one British company, Uni was British, and uh, Lever was the British company and Uni was a Holland, merged together, same product line, and they have a Unilever now throughout the world. And that's, even we can download their annual reports. We can look around before next lesson, and those ratios and all the formulas given in the handouts available on the Moodle page as well. So thanks for listening and attending today's session. And the next session will go through LO3 Learning Outcome 3. And in between, if you have any question, please drop me email. I'll get back to you as soon as possible. And thanks you. Have a good weekend. Thanks. Bye-bye.